This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant ratings service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Weak start. Stocks begin the new year with a thud. The Dow logging its worst day in nearly 2 months. But many professionals are betting on another big year for the market. Which sectors are worth your money now?
Virtue or vice? 'Tis the season to make resolutions, but are things that aren't good for your health good for your portfolio?
High alert. A warning from the government. Bakken crude may be more flammable than conventional oil. And as more gets shipped via rail, will the focus return to building out pipelines? All that and more tonight on Nightly Business Report for Thursday, January 2nd.
Good evening and Happy New Year, everyone. Well, a winter storm whipped through the Northeast on this first business day of 2014, and on Wall Street, stocks turned icy cold. All the major averages posted sharp declines, coming off a banner year for stocks. Some say investors were just booking profits after last year's historic run-up. Others are blaming an analyst downgrade of Apple for weakness in the tech sector, which affected a range of other companies. But whatever the reasons, all 10 of the S&P sectors ended the day lower, and it was the first time in 5 years that the first trading session of the new year ended to the downside. Here's how the major averages closed out today. The Dow tumbled 135 points, the Nasdaq was down 33, and the S&P lost 16 points. But gold rallied today after tumbling 28% in 2013, the worst annual decline in more than 3 decades. Prices of the precious metal rose nearly $23 an ounce today. It was a different story for oil. Crude prices fell almost $3 a barrel, ending at a 5-week low of $95.44.
Well, today may have been an ice patch for stock investors, but last year was a smooth ride. The S&P 500's 29% gain, for example, was 12 percentage points greater than the Europe 600 index's return. And for stocks that generated more than 90% of their sales here in the United States, the average gain was a whopping 33%. So will that trend continue in 2014, or should you broaden out globally, adding to your mix foreign shares or U.S. firms that do a lot of business overseas? Seema Modi takes a look.
They say home is where the heart is, but in 2013, home is where the money was. A third of all companies that made 90% or more of their sales in the U.S. beat the S&P 500, thanks to an improving economy and a stronger dollar. But this year, investors may be wise to expand their horizons. BofA Merrill Lynch equity strategist Savitha Subramaniam is advising clients to sell U.S.-centric stocks and to buy multinationals in 2014 because better than expected economic data is more likely to come from outside the U.S. in the coming year. Oppenheimer's chief market strategist John Stolfus says if you're going to take a global approach to investing in 2014, stick with consumer discretionary stocks.
Consumer discretionary because we're beginning to see around the world the development of a culture that mimics the U.S. consumer. And just as the consumers led the U.S. markets back, we would expect that will happen both in Europe as well as in Asia.
So which consumer-focused companies with global exposure look attractive? Oppenheimer says Nike, Mattel, Harley-Davidson, and Tiffany are some stocks to consider. But be forewarned, several experts caution that any type of distress, like political dysfunction or security concerns overseas, could send investors right back home. For Nightly Business Reports, I'm Seema Modi.
Our first market guest for 2014 says there are lots of reasons for investors to be optimistic for U.S. stocks this year. She's Liz Ann Saunders, Chief Investment Strategist for Charles Schwab and Company. Liz, you just heard our report with Seema Modi, who's saying that, move away from U.S.-centric stocks and embrace a global market strategy. Do you agree with that?
Well, if the call is to eliminate U.S. stocks in favor of all international stocks, I would say no. I think investors ought to be diversified, especially in today's environment where correlations are coming down and diversification matters again. I still think that the developed markets will outperform the emerging markets, but I think there's going to be bigger divergences. I think there'll be a bigger spread between the winners and losers within emerging markets, and I still think the U.S. market will do well. The spread, though, may be a bit different than it's been in the past year or so.
How worried, Liz Ann, should American investors be about the Fed tapering?
I don't think terribly worried. In fact, I think, if anything, the market had almost given permission to the Fed to start tapering. And when you listen to some investors weigh in on Fed tapering or lack thereof, when you talk to business leaders, way I think had gotten to the point where, if anything, it was holding back confidence. It was holding back business. I think a lot of folks felt it was time to rip the Band-Aid off. And I think the market's reaction, certainly the day of the Fed's announcement, and really since then, suggests that the market is ready for this, that we have moved into the expansion phase of the economy, and it's time to move toward more normal monetary policy.
So, Liz Ann, tell us a little bit more about the themes and the strategies that you're advising clients of Schwab to do.
Well,
for
one of the reasons why I'm optimistic about the U.S. economy is I think there's a transition happening over the past few years in favor of manufacturing in the U.S. I think we're in a renaissance of improved global competitiveness for U.S. manufacturers. One of our taglines has been that Middle America is our favorite emerging market. We're really seeing business come back from many of the emerging markets, particularly in China. The wage gap is narrowing. And it's nice to think of our economy as being productive again, to be export-oriented again, as opposed to just creating paper wealth, which, if you think about it, the last two expansions were more about paper wealth than anything else. And I think that feeds into the industrial part of the economy. It feeds into the consumer part of the economy. I think it probably boosts middle incomes, all of which I think are very good long-term stories for the U.S. It's not something that solves all of our problems immediately. It's kind of a slow-turning ship, but I think it's a very optimistic story for the next 5 to 10 years.
Take me very quickly through three other markets. 1, Europe; 2, China; 3, Japan.
Yeah, well, we're actually positive on all three of those. And in the case of China, that's a bit of a turn in the last few months for us, because we had a fairly negative view on China up until the recent period where the reforms were announced. Not because they will have an immediate effect on the Chinese economy, but it may be that thing, that inflection point that turns psychology, and I think gets investors to realize that they're very true about their desires to move the economy away from credit-led investment growth, more toward consumption growth. We are still believers in the turn that is happening in Japan, their desire to weaken the currency, the impact, that positive impact that that's having on the market. And Europe, we also think, hit an inflection point earlier in 2013, where manufacturing started to turn. And that's really all you need for equity markets, is to hit that inflection point, because markets look ahead.
It's a confusing time. It's great to have you on the program. Thanks so much, Liz Ann.
Thank you.
Liz Ann Saunders, Chief Investment Strategist for Charles Schwab & Company.
Well, it's a new year when many of us make New Year's resolutions to lose weight, eat better, or exercise more often. Why am I reading this? But how do the companies that help us keep those virtuous resolutions perform this time of year? Do shares usually rise along with those hopes in January? Dominic Chu takes a look.
'Tis the season for New Year's resolutions. So, can the idea of New Year's resolutions turn into New Year's investing ideas? Over the past 3 years, a few resolution themes stood out. First, physical fitness. Eat better, exercise more. On the diet front, there's Weight Watchers International. During the last 3 Januaries, shares of the company have posted healthy gains. But those gains seem to fizzle out by the end of each full year, along with those diets. It's a different story for the gym rats. Town Sports International, which owns New York, Boston, and Washington sports clubs, among others, posts healthy gains in January, and those gains gather even more steam as the year progressed. Second, getting your finances and investments in order. Take a look at shares of Morgan Stanley. It's posted strong gains on average over the last 3 Januaries, but that's about it. Shares were relatively flat for the rest of the year. Different story for personal finance software company Intuit, which posted more modest gains for the month, but got stronger to finish out each year. And third, for education stocks like DeVry and language learning company Rosetta Stone, the results have been pretty mixed. Some professional investors understand the thinking behind using consumer habits to make investing decisions, but cautioned against relying on them solely.
Forget the fact that we doubt the ability of those making the New Year's resolution to stay committed to it, but really, what would it do to the earnings growth potential throughout the remainder of the year, and thus the ability for the stock to appreciate? It's not going to be in our analysis and our strategy.
The bottom line here is, take a moment before buying a stock just because the company plays a role in your New Year's resolution. For Nightly Business Report, I'm Dominic Chu.
Now to the flip side of those resolution-related companies, to so-called sin stocks. We're talking here about companies behind things like cigarettes, booze, even fatty fast foods. Morgan Brennan takes a look at how these stocks have performed at the start of the new year.
They're certainly not good for your health, but they may be good for your investment portfolio. Sin stocks, these publicly traded companies that specialize in bad-for-you vices like tobacco, alcohol, gambling, even fast food. The negative stigmas attached to these companies have caused more traditional investors to steer clear. But those who have been willing to buy into the bad behavior have reaped sinful returns over the past decade. And when the economy's been bad, they've done even better.
Take Vice Investor. It's a mutual fund whose holdings include such big-name sin stocks as Diageo, Lorillard, and MGM Resorts. The fund returned more than the S&P 500 in 2013, and over the last 5 years, it's beat it by about 10%.
But here's where these sin stocks get even more interesting. With the exception of gambling, these purveyors of vice typically suffer a post-holiday hangover, perhaps due to all those New Year's resolutions. Nearly all of the major multi-billion-dollar companies of the tobacco, alcohol, and fast food industries have on average underperformed the S&P 500 over the past 3 years in January. But it doesn't seem to last. Investors relapse eventually, pushing these same stocks to outperform the S&P during the rest of the year. The only vice that seems to be immune to New Year's resolutions? Gambling, as the major casino operators have all been outperforming the S&P 500 regardless of the season. So while it may feel better to choose the socially responsible stocks, or at least stick to the ones that don't celebrate bad habits, it may just pay to invest in vices, because the January hangover doesn't always last. For Nightly Business Report, I'm Morgan Brennan.
So what are some of the investment themes that hedge fund managers are favoring in the new year? Well, Kate Kelly will join us in a few minutes with their strategies.
And today was a huge day for the Italian automaker Fiat. Shares soared more than 16% on the Milan exchange after announcing plans to buy up all the remaining shares of Chrysler that Fiat didn't already own. The $4.35 billion deal is due to close later this month, making Fiat the world's 7th largest automaker. Phil LeBeau joins us now from Chicago with more on what this deal means for Chrysler, for Fiat, and for investors. Phil, welcome and Happy New Year. Will this change the face of Chrysler in any measurable way, or Fiat here in the U.S.?
No, not in any measurable way. Look, what we see from Chrysler day in, day out here in the U.S. is not going to change. This does give Chrysler and Fiat more synergy, if you will. It should lower costs in certain areas, and this gives Fiat that bankroll, that cash flow that it needs to restructure its European operations, and that's really crucial here.
Yeah, you know, Phil, over the years, it looks like Chrysler is like a cat with 9 lives. So many different configurations over decades.
Right.
You sort of answered this, but I just want to get a little bit more on how critical is this new arrangement for Fiat to own all of Chrysler?
Very critical, because now it has access to the cash on hand at Chrysler, which, by the way, it's using some of that to pay off Viba for that 41.5% stake. Now that it has that money, it can invest in expanding in the two areas where the two lines where it really wants to expand. First of all, Chrysler and other overseas markets, because it's primarily a regional automaker here. And two, the luxury lines for Fiat. And we're talking about Alfa Romeo predominantly, but also for Maserati. Those brands, they think that they could have great growth in the United States, especially Alfa Romeo. And that's really what they're looking to do over the next year or two.
Alfa Romeo, Phil, was here years ago, hasn't been a major player in this country in really, I don't know, you tell me, decades. Are they going to come back?
Right.
We're going to see more of them here in the U.S.?
We have not seen it since 1995, but the first Alfa to go on sale here in the U.S. will go on sale in the second quarter. That's the 4C. And then what we'll see is an expansion over the next couple of years. And why is this important? Keep in mind, Tyler, the U.S. is still the #1 market in the world when it comes to luxury auto sales. Sergio Marchionne is looking at this and saying, I want a piece of that. That's where the real profits are. And that's why they need this money to expand, to bring Alfa over here to the U.S.
Real interesting development. Thanks a lot. Phil LeBeau reporting from Chicago. And still ahead on the program, could a number of rail accidents involving Bakken crude change the way it's transported? And could that impact the price of oil? The answers coming up.
Senate Democrats are looking to fast-track legislation to extend jobless benefits to the more than 1 million Americans who saw their long-term unemployment benefits expire just 5 days ago. Gene Sperling, director of the National Economic Council and the assistant to the president for economic policy, says that ending those benefits right now is bad for the economy.
We as a country have never cut off emergency unemployment benefits when long-term unemployment was this high. So to simply allow 1.3 million workers and their families to lose their benefits between Christmas and New Year's really doesn't reflect either economic common sense or our values. And over the course of a year, it will be 4.9 million people who will be affected.
Senate Majority Leader Harry Reid is looking to put a bill up for a vote as soon as this Monday.
Transporting crude via rail and not by pipeline has been gaining traction recently. But now several rail accidents involving oil being moved from the Bakken region of North Dakota have thrown that practice into question. Jackie DeAngelis reports.
Rail transport for crude supplies, a big theme in 2014, as estimates indicate that rail capacity could grow enough to handle 700 to 750,000 barrels of crude a day. But Monday's train derailment and explosion in Castleton, North Dakota, the third such accident involving crude oil out of North Dakota's Bakken shale region, have many on high alert. At issue, why unrefined crude supplies are exploding, which is typically more of a threat after crude has been refined. Today, a government agency issuing an alert that the type of crude being transported from the Bakken region may be more flammable than the traditional heavy crude oil. Still, the accidents raise a bigger question. Should the focus be on building out pipelines, which are a cheaper and perhaps safer means of transport? And if so, how quickly can pipelines be built to handle the increased production out of the U.S. and Canada? The National Transportation Safety Board leading the investigation into the accidents in North Dakota, but energy traders watching very closely to see how these accidents could potentially impact crude oil prices.
It appears that, traders are anticipating that oil prices will continue to move lower as we go through the next few years. But certainly if there were to be some limitations on crude by rail as a result of these safety issues, we could see the back end of the crude oil futures curve start to move higher.
As we await a decision on the Keystone Pipeline from Washington and the rail investigation continues, the energy industry grappling with some of these important issues. Industry experts saying that more domestic supply is good and it can reduce our dependence on foreign oil, but we have to figure out how to safely and efficiently transport the product. For Nightly Business Report, I'm Jackie DeAngelis.
And Continental Resources, this is one of the biggest producers of Bakken crude oil, took a hit on that government safety alert that Bakken crude may be more flammable than first thought. Shares dropped more than 4%.
Some good news by contrast for drivers. AAA says it'll cost even less this year to fill up your gas tank. The Automobile Association of America predicts prices at the pump will fall by a nickel this year on average to $3.40 a gallon. That's thanks to increased domestic production and a decline in exports. But as always, refinery issues and big storms remain a threat to those lower gas prices.
Apple rings in the new year with a downgrade, and that's where we begin tonight's Market Focus. Wells Fargo lowered its rating on Apple to market perform from outperform based on valuation concerns and fears that the company's profit margin will come under pressure when it introduces the next iPhone. Shares of the tech giant fell almost 1.5% to $553 and change. It was a different story for Bank of America. Shares popped on an upgrade from Citi. A Citi analyst lifted the bank's rating to a buy from neutral and upped its price target, saying the company is no longer impacted by legacy issues. Citi also expects the bank will be able to manage costs and grow revenue. Shares jumped about 3.5% to $16.10. Macy's and Martha Stewart Living Omnimedia have settled their legal battle over a breach of contract. As you'll recall, the dispute started when Stewart began to sell products at Macy's rival, JCPenney, despite a product deal with Macy's. Stewart's shares surged nearly 9% on the news to $4.57, but Macy's ended the day slightly lower to $53.39.
Urban Outfitters shares were higher today because of an upgrade from Jefferies. The firm upped the retailer's rating to buy from hold, saying the chain has done well in a tough environment. The analyst predicts Urban will get back on track in the new year. Shares popped almost 2% on this down day, closing at 37.78. Another upgrade, this one for U.S. Steel. KeyBank gave the company a buy rating from hold, saying the stock still has room to run based on the firm's positive 2014 pricing model for carbon hot-rolled steel. Shares were more than 2.5% higher to $30.28. And Warren Buffett's Berkshire Hathaway is increasing its stake in building products company USG Corp. According to an SEC filing, Berkshire is now the largest shareholder of USG with a 30.5% stake. The move adds to Berkshire's bet on the housing rebound. It also has positions in mortgage lenders and home builders. USG stock up a fraction. 28.41 was the close, while shares of Berkshire fell slightly. Those are the B shares to 117.50.
And this was not the way Samsung, the world's biggest smartphone maker, wanted to kick off the new year. Shares of the South Korean electronics giant, which don't trade here in the U.S., tumbled today, knocking more than $8 billion off the company's market value. Investors dumped the stock after Samsung predicted slowing profit growth at its mobile division.
Coming up, which sectors of the market will hedge fund managers be focused on in this new year? Find out what's hot, what's not for some of the world's swankiest investors in 2014.
A couple of online security breaches to fill you in on. Snapchat, the temporary photo and messaging service that a lot of young people use, has been struck by hackers. They published 4.5 million usernames and phone numbers on a public website, which has since been taken down. Meanwhile, hackers from the pro-Assad Syrian Electronic Army have claimed responsibility for hacking into Skype, both its Twitter account and Facebook page. The company, which is owned by Microsoft, has since retaken control of all its accounts.
2013 may have been a banner year for stocks, but the bond market did take a bit of a beating, and the world's biggest bond fund, the Total Return Fund at PIMCO, suffered its biggest annual loss since way back in 1994. The $244 billion fund run by the noted manager Bill Gross lost more than 1.9% last year.
Meanwhile, just 2 days into the new year, some big hedge fund managers are already focusing in on investment themes for 2014. Kate Kelly joins us now with a closer look at where some of these big investors will be putting their money this year. So I know, Kate, you've been going around and talking to all of your contacts in the hedge fund world. What are they telling you? What are their strategies?
Well, Susie, it's a little bit of a surprise to me after we saw the S&P stock market indicator up nearly 30% last year. But people are still bullish on stocks, I have to say, and they're looking at some specific things, which I can talk about. But dividend-paying stocks, for example, continue to be popular, and also event-driven. That means, mergers and acquisitions that are about to occur, or that the market thinks may occur, that may create some rise in value later on. So there are some specific focal points, but really stocks are a favorable area still.
How did they do as a group in 2013? Would I have been better off in an index fund?
Very good question, Tyler. You would, and you always would be, to be honest with you. If we look at a chart I got of the S&P 500 versus the average hedge fund, the hedge fund always underperforms the market. Now, a defender of hedge funds would say that's kind of the point. You don't want to put your whole portfolio into a hedge fund. It is a so-called hedging mechanism, so it's a way to kind of diversify your portfolio. But really, unless you're with one of the superstar hedge funds, which charge enormous fees in some cases, you're probably unlikely to beat the market.
Well, tell us what some of these superstars are doing. I mean, we look at hedge funds as doing things that the average investor doesn't do, even the average institution. Is there anything that surprised you?
That's a good point. And they're picking spots that you and I probably wouldn't pick if we were playing the markets. For instance, there was a hedge fund manager that sold gold puts. Basically, they were very bearish on gold and made a fortune last year. That was in the Wall Street Journal today. But going forward, again, they're bullish the stock market. They're going to pick specific names. They're also going to do their homework on some niche areas. Let's say emerging markets like perhaps a Mexico or an Argentina, where they see government debt that may be attractive and give you a nice return on your coupon. In the U.S., corporate debt and other bonds are not that attractive, they're saying. They just don't think the rate of return is really worth the effort. So you're going to see better returns, they believe, out of stocks, and I think that's why that's the focus. That and these niche areas that it's tough for the average investor to really get into.
You answered my question on whether an index fund would have outperformed. You say yes, at a lower price, too, by the way. But,
right.
But that doesn't mean, as you say, that you want to put all your money in there. 2013 was the year of the activist hedge fund investor, Loeb, Icon, and on and on. Do you expect that's going to be the way it's going to be in 2014?
I do, Tyler, with a little bit of a twist. People are trying to soften the rhetoric a little bit, and they're now talking about something called constructivism as opposed to activism. This is where it's a kinder, gentler shakeup of company management. And I think they're doing that because it's becoming so popular, and they don't want companies to fear them and fend them off.
All right, Kate, thanks very much.
Thank you.
Happy New Year to you. And finally tonight, about 70 million Americans, including the 3 people sitting at this table, are already feeling the brunt of or getting ready for the first nor'easter of the new year. It is expected to dump upwards of 18 inches of snow from the Midwest to New England overnight. If you're a business traveler or you know someone who is traveling today, tonight, tomorrow, be prepared for some big delays and to have a lot of patience, folks. According to FlightAware.com, more than 5,000 flights within or coming into or out of the U.S. were delayed today. Another 1,900 were canceled. Let's hope things get a lot better.
I'm glad we're not traveling.
Not traveling,
but
just
for
traveling
those of you who are, be safe. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for joining us.
Thanks from me as well. Have a great night. We'll see you tomorrow.
Nightly Business Report has been brought to you in part by
TheStreet.com, up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. On Wall Street today, all the major averages posted sharp declines on the first trading day of 2014, coming off a banner year for stocks. Some say investors were just booking profits after last year's historic run-up. Others are blaming an analyst downgrade of Apple for weakness in the tech sector, which affected a range of other companies. But whatever the reasons, it was the first time since 2008 that the first trading session of the new year ended to the downside. The Dow tumbled 135 points, the Nasdaq was down 33, and the S&P 500 lost 16 points. And Italy's Fiat will pay nearly $4.5 billion to buy the remaining shares of Chrysler that it doesn't already own. Be sure to tune in to Nightly Business Report right here on your public television station.